ACM Research's newer platforms are exploding at triple-digit growth rates, while the legacy single-wafer cleaning line just shrank 14%. The entire quarter is a product mix transition happening in real time. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. ACM Research gets graded and traded. So on the headline, revenue came in about 9% ahead of estimates at $292.9 million, and that's up 36% year over year. That is a clean, strong top-line print. And on the EPS line, they reported $1.23 per share, which looks like a plus 97% monster beat. But here's the catch. Most of that came from a $69.6 million unrealized gain on short-term investments held at the Shanghai subsidiary. Strip that out, and the clean non-GAAP EPS was 61 cents versus 55 cents a year ago. That's about 11% growth, not the plus 180% the headline suggested. So on the beat itself. And remember, we're grading against the clean numbers, not the mark-to-market inflated headline. This earns an A. A 9% revenue beat combined with 36% year-over-year growth and a clean double-digit EPS beat is genuinely strong, just not the plus 97% monster the reported number suggested. And on consistency, this earns a B. They've been reliable beaters, but not the kind of every quarter blow the doors off history that would push this into A territory. Let's talk about the positives from the report. Revenue was up 36% year over year to $292.9 million. That's real growth in a semi-cap equipment name, and shipments were up 36% too, which tells me the top line is being backed by actual product going out the door. The star of the show was ECP, furnace, and other technologies revenue. That line jumped 168% year over year to $128.5 million. That is the newer product platforms carrying the growth, and it's exactly what the bull case on this name required. Management also raised the low end of full-year guidance by $45 million, tightening the range to $1.125 to $1.175 billion. That's 25 to 30% full-year growth, and it's a real signal of confidence in the back half. The balance sheet is a fortress. They ended the quarter with $1 billion in net cash and $1.36 billion in total cash and short-term deposits. That gives them plenty of firepower to fund the Oregon facility build-out without any financing pressure. An operating margin expanded to 17% from 14.7% a year ago. Operating expenses as a percent of revenue dropped from about 34% to 29%. That's real operating leverage showing up as revenue scales. So on profitability, this earns a B. The operating leverage story is genuinely working, but I can't ignore that gross margin compressed from 48.5% to 46%. The growth is coming at slightly lower unit economics, so it's a good grade, not a great one. Now let's talk about the negatives from the report. The headline GAAP EPS of $1.23 was inflated by a $69.6 million unrealized gain on investments at the Shanghai subsidiary. Strip that out, and the clean number is 61 cents, up about 11% year over year. That's a very different picture than the plus 180% the headline showed. Gross margin compressed from 48.5% down to 46%. That means the revenue growth is coming with slightly lower unit economics, and management flagged product mix, currency, and sales volume as ongoing variables that will keep margin choppy going forward. The legacy single-wafer cleaning line shrank from $155 million down to $133 million, about 14% lower year over year. So the newer categories are carrying the growth while the original franchise is contracting. That creates real mix shift risk if the new product ramps ever slow down. Guidance explicitly cites the continuing impact from international trade policy and supply chain constraints as ongoing risks. For a company with heavy China exposure, that's a live headline risk that could compress the guidance range at any point. And here's a structural one people miss. Net income attributable to non-controlling interests jumped from $6.5 million to $33.3 million. A growing share of consolidated profit is flowing to the Shanghai subsidiaries' minority holders rather than to ACM Research parent shareholders. That's a permanent feature of the corporate setup you need to model correctly. On guidance, this earns a B+. They raised the low end by $45 million and tightened the range. And that's a genuine confidence signal into the back half. Not an A because they didn't touch the high end, but a real raise is a real raise. And on red flags, I'm at a C+. The GAAP EPS inflation from the unrealized gain, the legacy cleaning line shrinking 14%, and the China trade policy overhang are all real concerns I have to weigh against an otherwise strong operational print. Putting it all together, this is a fundamentally strong quarter with some real headline noise around it. Revenue up 36%, guidance raised, new product ramps working, and $1 billion in net cash on the balance sheet. But the reported EPS was inflated by a mark-to-market gain, gross margin compressed, and the China trade policy overhang isn't going anywhere. All in, I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The raised guidance floor around $1.125 billion gives me a real fundamental anchor to work from, and management even mentioned better visibility on order activity, so I feel okay getting in here. That said, I'm not chasing this thing into strength. If I want exposure, I'd rather sell a cash-secured put on a pullback and let the premium pay me while I wait for my price. For outright share buys, I'm watching for dips tied to China trade policy headlines because those pullbacks usually aren't about the business breaking, they're just noise. So my move here is simple. I wait for post-print weakness before I do anything. When I'm picking my cash-secured put strikes here, I want my floor sitting below a level that would only break if guidance actually got cut or a China policy shock hit. The $1 billion in net cash on the balance sheet makes me comfortable if I do get assigned, because there is no financial risk hiding underneath this name. Gross margins are still running in the mid 40% range, so even if quarterly numbers wiggle, the operational floor feels stable enough for me to sell puts against. That's why my rule is straightforward. I sell below the guidance floor. If I'm already holding shares, this print keeps me in the seat. 36% revenue growth, raised guidance, and 168% growth in that new product line all confirm why I own it. The $1 billion in net cash takes balance sheet risk basically off the table for me, so I'm not worried about the company running into trouble while I wait. The only time I'd trim is if the position has grown too big for my portfolio, mostly because the China trade policy headline risk isn't going away anytime soon. So my stance on my shares is clear. I'm holding, trimming only if oversized. On my covered calls, I'm not selling anything near the money into this strength. The raised guidance and that tightened low end tell me management sees more upside coming. If I cap too tight here, I risk getting my shares called away right before the market repricing this stock higher, and that's the worst outcome for a wheel trader. Instead, I'd roll my short calls up and out on any short-term pop, keeping my strikes above levels that make sense for a business growing 25 to 30% with multiple product cycles working. That's the playbook I'm running on my calls. I roll up and out on rips. On my long-dated call positions, this report is exactly what I wanted to see. The 2,000th chamber shipment and the new production orders are converting the story from promise into real volume. Management is still framing a $4 billion long-term revenue target, and with the Oregon facility making progress, my 12 to 24-month view feels well supported. The unrealized gain noise in the quarterly numbers doesn't change my math at all. What matters for my long calls is that new products are moving from evaluation into real orders. So on the leaps, my move is easy. I'm holding and adding on weakness. If I'm sitting underwater on this name, this print actually validates my original thesis rather than breaking it. Revenue is up 36% year over year, which is the growth I underwrote. New product categories are ramping at triple-digit growth rates, and management raised the low end of their outlook, so the business is doing exactly what my bull case required. The one thing keeping me disciplined on ads is the China trade policy overhang that management themselves keep flagging. That means I size any ad smaller than I normally would. So if I'm underwater here, my plan is measured. I'll average down with careful sizing. Bottom line, this print earns a B+ from me. The operational story is intact. The new product platforms are converting from evaluation into volume, and management raised the guidance floor with real conviction. Just don't get fooled by the headline EPS number. Thanks for watching, and I'll see you on the next one.